Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. Last week went pretty well, so we're back for week 2 of our extended show.
They let us stay here.
Here we are, and we have a lot to talk about. Let's get to the biggest stories right now. In the $20 trillion global ETF industry, stocks back in the green, but Bitcoin still in the red, following a roller coaster ride at the end of last week. We'll take a look at how it's impacting crypto ETFs.
And we're going to check in with Bob Michael of JPMorgan Asset Management on concerns Chinese banks are being told to pull back on their holdings of U.S. government bonds.
And we also speak to Chris Marangi of Gabelli Funds on his sports ETF after the Seattle Seahawks dominated the New England Patriots in the Super Bowl. That makes it sound a little bit more exciting than it was. But as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now, and he's looking at the flows. Eric, what do you got?
Thank you, Katie Scarlett. Yes, that was a boring Super Bowl. Last year, much more interesting when the Eagles destroyed the Chiefs. But I'm biased. All right, look, VU at the top, shocker, right? As usual, $6 billion, by the way. VU is now taking close to $1 billion a day. At this rate, it's going to pass $200 billion in flows, breaking the all-time record. But look what's beneath it, RSP. This is the equal-weighted S&P. We're hearing a lot more about investing in equities, but maybe buying some of the less-loved sectors. RSP equal weights, that's the way to do that. And then going down here, the Dow Jones ETF, which rarely sees flows, is actually up over the S&P by a good portion this year and has just hit an all-time high. So people are buying that because of its sector weightings. You got some cash in here, small cap. Someone's trying again to make that happen. We'll see. And SLV finally got some flows. It's been all over the map. As you know, silver has just been very volatile. SPY with negative $4 billion in outflows. Same with the Qs, so maybe a little trader risk off. GLD with some outflows. So a little bit trader crowd risk off here. That's my takeaway there. Speaking of risk off, let's look at Bitcoin, okay? So obviously huge sell-off, like 45% since the peak. Here's the flows cumulative. This is the most important thing. When the ETFs launched, they took in $12 billion right off the bat, big. Then they took in $18 billion 6 months, and then $40 billion in the first year, came down a little when that sell-off happened. Then they got up to $62 billion. Then the flows, $7 billion has come out. So not that bad, because if I showed you a chart of Bitcoin, it would be like this. So the flows have been much sturdier than the price. We predicted that ETF holders would be stronger hands than people thought, which does beg the question, Katie, where is the selling coming from?
It's a good question, Eric. Let's ask that question to Bitwise CIO Matt Hougan right now. Matt, great to have you with us. Of course, Bitwise manages a whole stable of crypto ETFs here. Where do you fall on that question? Where do you think this selling pressure is coming from?
Yeah, I think Eric made a great point. It's not coming from ETF investors. They have been remarkably steady, diamond hands. It's mostly coming from OG retail crypto investors, the people who own the vast majority of the asset class. We should remember, Bitcoin ETFs have been a huge win, right? Eric showed $60 billion of net inflows, but this is a $1.5 trillion asset. The vast majority of the asset is controlled by the original investors in Bitcoin, the people who accumulated it over the decade before ETFs launched. And those are the people who have been trimming their positions and the reason why the market is down over the last 3 or 4 months.
So, Matt, that begs the question, who are the buyers of Bitcoin ETFs, the buyers and holders? Are there, if they're not the true believers and the original guys, because those guys own Bitcoin, who are they?
Yeah, absolutely. We're seeing a transition of ownership from this original retail investor crowd to an institutional crowd, right? The net buyers right now are financial advisors, family offices, institutions. We're seeing that at Bitwise. We had strong inflows last week across the board, across many of our products. Those are the long-term investors. They're going to be the ones that ultimately own a big chunk of the Bitcoin market. I think the market is down right now because the people who have been selling faster than these new institutional purchasers have been buying. But make no mistake, they are still bullish. When I go out and meet with advisors, I was in the field last week, they're looking at this as an opportunity because they're still starting, most of them, from zero. So they see this as a great entry point. And I think you're going to see those institutional flows pick up. I bet we'll be back above that $60 billion level, in a few months, almost regardless of what happens with the direction of price.
So, Matt, let's go back to the OGs, because I debate this with my friends on Twitter all the time. These people, are they still into Bitcoin? This is what I worry about. I get, like, okay, you were in it for 10 years. You survived so many sell-offs. You want to take some profits. You earned it, silent IPO. But are they taking their ball and going home? Because They don't like that it's been so institutionalized. Someone compared it to when your parents joined Facebook and everybody left. I mean, is that what's going on here? Are they still believers? Because I think you need the base still to come along for this ride, or are they going somewhere else?
Yeah, they're mostly still believers, Eric. It's a great question. I think it's about 80-20. So there is a cypherpunk, libertarian, OG deep core of Bitcoin that maybe is frustrated that Larry Fink and BlackRock is a big player in that space, but that's a shrinking minority. We speak with many of these investors. We've been working with them over the last couple of years. What they're doing is trimming their sales. You have to remember, these are people who invested a few thousand, maybe $10,000, and ended up with millions of dollars. And they were looking at crypto's familiar 4-year cycle. They've lived through that 4-year cycle in the past, where the 4th year is typically a big pullback year. And they wanted to take some profits off the table, but they haven't turned their back on Bitcoin. The vast majority are still in it, and they're being augmented by new institutional investors. I think the story that most of OG crypto is giving up on the space, it just doesn't align with the people that we talk to, with the investors that are working with Bitwise.
Well, to continue the metaphor here, I'm still on Facebook, but maybe to Eric's point, only to keep up with what my mom and her friends are doing. Let's talk a little bit about the world beyond Bitcoin, though, because I'm taking a look at some of the flows into and out of your products year to date. Interesting to see at the top, we have your XRP fund taking in about $93 million. Not huge, but of course, it's a positive inflow on what's been a pretty down market, pretty sour sentiment for crypto overall. What is going on with XRP? I have to imagine that that's a token that people who aren't crypto natives or really in the space know exactly what that is.
Yeah, that's exactly right. There's actually been no days with net outflows out of that ETF since we launched it. It's really remarkable. I think that that tells you is there is a group of people, the XRP army, who are dedicated to the asset, who have bought it and held it for many years, and they're not giving up on the space. You know, XRP and its sort of parent originator Ripple won a major lawsuit against the SEC at the start of the year. Those investors think they're going to reap the rewards of being out of that sort of regulatory onslaught over the next 5 years. And they don't care if the market is up, down, or sideways. They've seen that before. This has been a volatile market for years. So yeah, that has been up only in terms of inflows. It's been really remarkable.
So if I had to sum up our conversation so far, pretty much the theme is nothing's wrong, keep moving ahead. But is there anything within the crypto space, Matt, that gives you pause, that makes you think maybe this time around it's a little bit different than, you know, the once every 4-year sell-offs that we tend to see in crypto?
Yeah, look, I think broadly this is just a traditional crypto winter. Now, crypto winters can be deep and dark and very cold, but the right framework is 2022 or 2018, the last time crypto pulled back. During winters, bad news looks really scary. So the 4-year cycle looks really scary. Quantum risk looks really scary. Maybe you're worried about Kevin Warsh sort of right-sizing the Fed, and that seems really scary. And conversely, the good news sort of vanishes into the corner. So the growth of stablecoins and tokenization is hard to see. The approvals at wirehouses of Bitcoin ETFs last quarter is hard to see. What we've seen in crypto winters past is that people who add in at these points have historically done well. If you bought at the end of 2018, you're up 2,000%. If you bought at the end of 2022, you're up 300%. I think that will repeat. Is there an existential threat to crypto right now? I don't see it. I see the long-term growth of stablecoins, tokenization, worries about fiat currencies. Those will feed back into crypto. They sort of tell you that this time is different are the 4 most expensive words in finance. I don't think this time is different for Bitcoin or crypto. I think this is a traditional crypto winter. We'll round out. And I think the people who dollar cost average in now may be happy in the future that they do it, because I think the long-term trajectory is solid.
All right, Matt, great to have you with us to make a little bit of sense of it all. That is Matt Hougan of Bitwise. Now coming up, Ron Barron, longtime Elon Musk investor, a relative newcomer to the ETF universe. He's already subverting norms in the industry. We're going to tell you what that means next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with a software ETF. Of course, software, the SaaS apocalypse has been the talk of the town. You're taking a look at IGV over the past 10 days. Take a look at this wipeout, down about 14% or so. You can see that there's a little bit of a dip buying bid emerging here just in the last day or so. We'll see if that holds. Let's also talk about Ether ETF assets. We were just talking about crypto with Matt Hougan of Bitwise. You can see that when it comes to ETFs that hold Ethereum, really that AUM is on its way down as we continue to watch this fallout. Let's talk a little bit, though, about Ron B. This is the Barron First Principles ETF. We've been talking about this a little bit, but it's interesting because if you take a look at the holdings, SpaceX, as of today, is 18% of the fund, which is interesting, Scarlett, because the SEC does have that 15% cap on illiquid assets. 18 is more than 15. But as it turns out, my reporting revealing that Barron is basically classifying their SpaceX holdings as less liquid rather than illiquid. It's only the illiquid category that has that cap on.
What is the definition of illiquid versus less liquid? I don't understand. Is it in the eye of the beholder?
Well, it's interesting. So the SEC, they have these 4 liquidity buckets that maybe not a lot of people knew. You have highly liquid, moderately liquid, less liquid, and then illiquid. And as it turns out, and I was having this conversation with David Cohen of Bloomberg Intelligence, who Eric, you might know. And it turns out that it's the fund issuer that classifies the liquidity profile of their holdings rather than the SEC. And Eric, I feel like this was a little known fact until you had someone test the limits here.
Yeah, I didn't realize it was up to the issuer. But, you know, I've seen ETFs over the 20 years I've been covering. They will push the envelope. You give them an inch, they'll take a mile. So it's interesting they're pushing this particular issue. Their reasoning is that SpaceX obviously has big secondary market volume. And if you look at the other, that's the #1 most traded private. Then you get to ByteDance, Anthropic, OpenAI, and XAI, which is getting folded into SpaceX apparently. So there could be other less liquid privates that come in. Plus, there's a lot of secondary markets opening it up. We had NASDAQ on a couple months ago talking about that. So it's possible we could see more of this. Knowing the ETF industry, we will.
Well, part of the reason I wanted to report this out a little bit more is because it's interesting to think that a fund manager might categorize one stock, shares of a particular company as one liquidity bucket, and another fund manager might treat them differently. And actually, we had this conversation with Cathie Wood last week. Let's take a listen.
We actually have gone to some of our private companies, the ones in the interval fund, saying, hey, we'd love to add you into our ETFs because we think this is such an important story. What we found over time is that they have been reticent.
And so that was interesting, too. I mean, we talk about it from the issuer perspective all the time of adding privates, but the managers, the executives of these private companies, they might not necessarily want shares of their private company in the highly liquid ETF vehicle.
And this is interesting. ARK Venture Fund is an interval fund. It has all these privates in there. It's actually has all the ones that you know and love in there, yet not a lot of inflows. But Cathie has to keep a good relationship with these privates and the venture funds, the capitalists that set them up, because she's got to put new companies in this fund. Ron only deals with the Elon companies. So there's a lot of subplots here to deal with. But what is interesting is when you have an interval fund, again, no bites, but you put just a little bit of that in an ETF, Ron Barron, all of a sudden, it took in a lot of flows. It's up 40% in assets in 2 weeks since it's added SpaceX. So add it and they will come is the message here.
Well, I get into all the subplots in my ETF newsletter. It's all about the ETF industry. You can subscribe to ETF IQ, the newsletter, at Bloomberg.com/ETF IQ newsletter. We made it really easy, Scarlett.
Of course we did. All right, coming up, Bob Michael of JPMorgan Asset Management, home of the Flexible Debt ETF and International Bond Opportunities ETF, will join us next. We talk fixed income as we learn that Alphabet has drawn more than $100 billion of demand in its massive bond sale today. This is ETF IQ.
I'm I'm Norma Melinda. Let's take a look at our midday movers. First up, Alphabet says it's looking to raise about $15 billion from a high-grade dollar bond sale in the United States, adding to a borrowing spree by companies at the forefront of the AI investment boom. We just learned that the sale is seeing more than $100 billion in demand. Meanwhile, it's also raising funds in Europe. The tech firm also plans to sell an 100-year bond, the first such long-dated issue by a tech company since the late 1990s. Meanwhile, Oracle shares jumped as much as 10% for their best day since September after analysts at D.A. Davidson upgraded the stock to buy from neutral. The firm said it expects OpenAI to exceed expectations for model performance and capital raising in the next few weeks, and for Oracle to be a beneficiary of that optimism. Shares of Oracle are down more than 15% so far this year. And finally, App 11 shares surged for double-digit returns today after Citi said the company's e-commerce clients were up 3% week over week. App 11 shares have tumbled more than 30% so far this year. Those are your midday movers. I'm Norma Melinda.
All right, well, China's regulators are telling major banks to cut back on U.S. Treasury exposure, citing concentration risk and market volatility. Now, officials say the move isn't about politics or losing trust in the United States. It's just about playing it safer. Let's discuss with Bob Michael. He is CIO and global head of fixed income over at JPMorgan Asset Management. To start, Bob, it's great to see you.
Happy to be here.
So we're going to talk about ETFs, of course, but let's start with that news overnight. As you might imagine, it made quite the splash with the terminal audience, and it sort of builds on what we've been hearing about quiet quitting the U.S. Treasury market. I wonder what you make of some of these news items, some of this commentary that we're getting, because, I mean, you take a look at the Treasury market right now, not too much movement in the yields.
Yeah, that comment overnight to us was a whole lot of nothing. We've been looking at China for a while. They've been diversifying their reserves. They've been slowly bringing down their Treasury holdings and going into other asset classes, gold being a big one, but also holding other sovereign bonds. So it seems to be a progression, more news headline than anything that should be shocking to markets, and that's what you saw in markets.
But there's now this expectation, at least, or a narrative out there of long-term structural outflows from U.S. dollar assets. How concerned are you about that?
Well, we're not seeing it. So I hear a lot about it. Everyone likes to talk about it. We have an enormous client base that's overseas. A lot of it institutional, a lot of them hold U.S. assets. Some are interested in possibly hedging dollar back to their base currency. But right now, all I'm seeing is interest in U.S. bonds. I'm headed to Australia at the end of this week for a week, and they've booked me solid 5 days in a row with clients that want to talk about the U.S. bond market.
Thank you, by the way, because one of our big themes is this ginormous gap between Sell America and the headlines and the actual flows. I don't know where it comes from. It's almost like the media is wish casting America to be sold, but I don't see it anywhere. I mean, you obviously went over evidence that you're not seeing it either. The only thing that is true from that side is that international has had a good run. So do you buy international on top of the U.S. or just stick to the U.S.?
Well, we've been doing that for a while, and you have to look for value. I would say the backdrop is there's a lot of money sloshing around in the system. Everyone looks at money market fund assets. They're closing in on $8 trillion. But we look at M2 as well, which is a broader supply of money. That's closing in on $23 trillion. So that money will find undervalued assets, go into it. We've been buying emerging market debt for over a year and a half. It's suddenly become popular. We see value in foreign government bonds. We're in there buying. We're not looking to sell America. We're just looking to go where the value is.
And outside of the world of government debt, I do want to talk a little bit about corporate credit markets, because one of the red headlines that hit the terminal this morning was Alphabet seeking to raise about $15 billion from a U.S. bond sale. Of course, they have big AI hopes and dreams, tapping the bond markets to do it. Reporting showing that that sale draws drew over $100 billion worth of demand. I wonder how you're thinking about this debt deluge when it comes to some of these hyperscalers, because we talk about concentration risk in U.S. equity markets all the time. Do you think that as we see more of these big tech firms come into the primary markets that we might have that conversation in corporate credit as well?
Well, we have to look at what the use of proceeds is going to. And right now, they're producing evidence that there's demand at the other end. They have to invest and build the infrastructure. The revenues will be there. They'll pay down the debt. So for us, it makes a lot of sense now. We looked at the impact of AI across JPMorgan Chase. Every line of business has seized the opportunity and is investing heavily in it. We don't do that unless we see a benefit on the other side. And efficiency is the big benefit. You don't want to be left behind. The hyperscalers don't want to be left behind. We'll be in these deals.
You'll be in these deals. So I wonder if, with Alphabet talking about perhaps issuing a 100-year note, which kind of blows my mind, given that we don't know what's going to happen in 5 weeks. Is that something that the JPMorgan Flexible Debt ETF, JFLX, might look into? How do you decide what maturity or what exposure you want to any given company?
Yeah, I believe there was an Austria 1,000-year bond, like, I don't know, 10 years ago or something like that.
Also head scratcher.
Yeah, a 100-year bond for a tech company, you wonder who will be paying it off. But the good news is, for anyone who's bought it, they won't be around to have to answer those questions. So it's about pricing. It's also about the positive convexity. It's also about long-term liabilities, creating some sort of match out there. Remember, there's no such thing as a bad bond, just a bad price. So if it's priced correctly and we see a place for it, yeah, we would put it in something like JFlex.
All right, about 45 seconds. The new Fed chair, there's been this reaction, he's going to be more hawkish than people think, but I don't know. I mean, obviously, Trump wants rates down, was going to pick a guy probably who's going to bring rates down. Is that where you're seeing it? I see you have bonds that are in several different duration buckets. What's your take on that?
Yeah, our feeling is the pressure on rates is downward, that you do have a Fed chair going in who may believe the balance should be shrunk, the balance sheet, but also believes that probably rates should be a lot lower than here. Hopefully, we'll see inflation moderate at the back end of the year, and that will give scope for the Fed to bring down rates a couple more times.
Bob, always a pleasure. Thank you so much for joining us today.
Thanks for inviting me.
Bob Michael of JPMorgan Asset Management. Now, coming up on ETF IQ, the Seahawks won the big game. So we speak to Chris Marangi of Gabelli Funds on the opportunities in sports. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, you teased it earlier. We're going to talk sports today. This is the latest attempt to try to ETFize sports. Fans came out, I don't know, 5 or 6 years ago, had to liquidate. There was one before that. So we'll see if third time's a charm here. Work for airlines. So this is Gabelli Opportunities. It's an active fund picking sports stocks, basically, like teams and also the media. You can see here the fee is 0. Interesting. Now, it's a waiver. In a year, it's 90. But for now, they have a waiver to try to get people in the door, I guess. You can see it's very low assets, but it just opened. I mean, it's literally just came out this year, 13 million. Let's look at the holdings here. You'll recognize some of these holdings. Some you won't, but some you will. Liberty, Madison Square Garden, of course. Atlanta Braves, Manchester United, see what Walt Disney, that would be more of the media, Madison Square Garden again. Then we've got some other stuff down here, Ferrari. You get the idea. So let's look at the performance. This thing is 75% communication sector stocks. So I figure we should compare it to the market at whole, but that's really the sector it's going to have to beat. So right now it's down a bit compared to the market. It'll have to get that up. These active funds, Katie, and the thematic funds, typically they need a shiny object moment to get some looks.
All right, Eric, thank you. Joining us to talk about this ETF, I'm pleased to say, is Chris Marangi. He is CO-CIO of Value over at Gabelli Funds. Chris, great to have you with us.
very good timing with the Super Bowl yesterday. Maybe that's our shiny object moment.
Well, that's exactly what I was going to say. I mean, you think about potential catalysts here. Talk to us about how that lands within this portfolio, which, I mean, you take a look at your top industry groups: entertainment, media, software.
So obviously no publicly listed NFL teams, but we do benefit on the media partners side of the house. We do own Comcast, for example, which did quite well, both between the Olympics on NBC and with Peacock. So they're a beneficiary. The bigger event, however, is the biggest media event in the world, and that comes with the World Cup. Football known to the rest of the world. And that we think will increase the interest in soccer here in the U.S.
So these are all publicly traded companies, but if you were to, and you could, get a hold of some private companies, is that something you would consider?
No, we're looking, there are plenty of other funds, firms that do that. We're trying to differentiate ourselves. Total liquidity, which is what we're offering here, and transparency.
So this would be what we call a member of the Lazarus list, where somebody goes and resurrects an ETF idea that didn't make it. Now, this happened twice, right? So what makes you think you can make it successful where the other people failed? So
when I started covering the media industry 23 years ago, I was serendipitous in that I covered the Dolan companies, which of course had the Madison Square Garden companies, and then Liberty Media, which sprang forth, Formula One, the Braves, and Live Nation. So there's a lot more public companies today than there were many years ago, and we've been investing in these companies. Our clients have been investing in these companies for over 20 years.
And it's interesting, if I go down the list here of your holdings, I don't necessarily see DraftKings or Flutter, which owns FanDuel. Was that a conscious decision?
Yeah, and we obviously are trying to apply, this is active advantage, as Eric mentioned, and we are trying to apply our value lens to that. Obviously a lot of controversy around those betting names, and they could be investments in the future. They aren't today.
How are you hedging currency exposure if you are investing in companies overseas?
So we're not doing that today. Obviously, foreign companies, including and especially the foreign listed soccer clubs, are in this fund, but not something we've done to date.
What's the stock in here people will be surprised that is doing so well?
Well, actually, one of the stocks that may be surprising is Rogers Communications, one of our larger holdings, and actually sports assets. They own the Blue Jays, the Raptors, and the Maple Leafs, of course, as well as the football club in Toronto. It's about half the value of that otherwise telecommunications converged operator. And we think that those sports assets are probably going to come public as a standalone entity sometime this year. So it's a little bit of a hidden sports play.
And so, as Eric mentioned, I mean, you just launched this fund. It's scarcely more than a month old, but who did you launch it for? When you were, putting this together, what intended audience did you have in mind?
So this was really supposed to be a retail product for the average person who's got a brokerage account, who wants to pick up on what the ultra wealthy have been doing for many, many years, obviously, and benefiting from the growth in sports. One thing that has surprised me is the number of calls we've gotten from family offices. Because just about every family office out there wants to participate. If you've got enough money, if you're big enough, you can participate directly through an LP stake or buying a whole team, or you can participate in a private equity fund for big fees. A lot of them are interested in a diversified portfolio for, as we said, zero fees, at least for now.
Would you consider adding a company like KKR, which has just acquired Arctos Partners?
Something that we've looked at. Obviously, there are some derivative plays that we're considering. So that would be one. CVC, another publicly traded private equity firm, has a big interest in sports for all the same reasons that we do.
All right, Chris, really interesting fund. Hope to have you back in a couple months to talk about it, especially as we get closer to that World Cup. That is Chris Marangi of Gabelli Funds. Now, coming up last week, we spoke exclusively to Vangard CEO Salim Ramji, and since then, we've learned that he's poaching talent from his rivals. A busy man. We'll give you the details next. This is ETF IQ on Bloomberg.
We're just about halfway through the trading day in New York. I'm Norma Linda. Let's take a look at your midday movers. First up, Novo Nordisk said it's suing telehealth firm Hims & Hers for making knockoffs of its obesity medicines, even as Hims & Hers scrapped plans to sell a copycat version of the Wegovy pill. The lawsuit targets not only Hims' copycat pill, but also shots that mimic Novo's Wegovy and Ozempic medications. with Novo arguing that the knockoff products are putting patients' health and well-being at risk. Shares of Novo Nordisk are climbing while Hims & Hers plunges to its lowest level since 2024. Meanwhile, Valero is soaring for its biggest intraday gain on record after Transocean agreed to acquire the offshore drilling firm in an all-stock transaction valued at approximately $5.8 billion. Shares of Transocean have reversed early session declines, rising to their highest level since 2024. And lastly, Eli Lilly has agreed to buy closely held U.S. biotech Orna Therapeutics for up to $2.4 billion in cash to expand its pipeline beyond the obesity drugs Zepbound. Orna is developing treatments for autoimmune diseases such as rheumatoid arthritis and multiple sclerosis. This deal includes upfront payments and subsequent payouts based on meeting certain milestones. Those are your midday movers. I'm Nora Melinda.
All right, now let's get you to the ETF life cycle, where we walk you through the three main stages of ETFs, from initial filing to final farewell. Step one is the filing. The paperwork is in for the VanEck Digital Native Economy ETF. The fund will include companies that make the majority of their money from online finance, online marketplaces, digital sports betting, and video games. Step two is the launch. The ProShares CoinDesk 20 crypto ETF began trading last week, right as Bitcoin went on its wild ride, plunging to $60,000 before rebounding back above $70,000. Ticker KRYP tracks the top 20 cryptocurrencies by market cap using swaps, futures, and other derivatives instead of directly owning the assets. And for some, the final stage is farewell. Goldman Sachs shutting down GBXB, its homegrown U.S. large cap buffer 2 ETF. The move comes a couple of months after Goldman paid $2 billion to buy Innovator Capital Management, which, of course, specializes in those defined outcome ETFs that give Goldman an entire lineup of funds, limiting downside risk while capping upside potential.
Yeah, it's going to be interesting to see that deal finally close. But let's keep this life cycle conversation going with Aga Kuplinska. She is SVP of Product Development over at Tidal. Aga, it's great to have you with us. So you think about these ETFs that are launching, coming to market. A lot of them are doing so with the help of a white label issuer such as Tidal. So with that in mind, talk us through some of the early trends that you're seeing start to develop in 2026.
It's a pleasure to be here. Thank you for having me. So from Tidal's perspective, and this is not unique to our observations, the entire ETF ecosystem can probably see that active strategies continue to dominate the overall ETF market. Looking at last couple of years, in 2024, almost 80% of all new product launches were active ETFs, and that number is even higher in 2025. Then derivative-based strategies are one of the biggest product development trends right now, especially options overlays to generate income. New product launches exploded in the last couple of years as well, with among strategies where the derivative income is the core objective. There were 50 launches in 2024, more than 100 in 2025, and Tidal accounted for almost half of that. We currently run one of the largest derivative risk management program in the US, based on a number of products that we trade and monitor on a daily basis, which basically puts us at the center of this trend. And I would say right now, the market is going through overlay everything phase, where issuers can take almost any underlying and layer on some option strategies for income. This includes enhancing income on already income producing assets or adding income to spaces that were traditionally not known for as income plays.
Aga, is there ever any instance where you would say no to a proposed ETF, especially in the derivative space, that it's getting kind of crowded?
Income remains the number one selling point in 2026. So demand for yield never goes away among investors, especially in uncertain markets where when growth is uncertain, that added benefit of income seems to resonate well with investors. And this all started, with simple cover call strategies. They've been around for years, and white space is getting harder to find. So when we would say no is typically when something's been done or been done multiple times. The next wave of innovation in sort of options overlays is more about outcome-oriented strategies around, for example, like income stability objectives or risk controls. So that's where we see the most innovations taking place.
And let me ask you a question. I get asked this when I travel around and meet with different people. I'll occasionally get asked, hey, how can I launch an ETF? I have this great idea. And usually I recommend one of the 3 white label issuers, and usually I give them Mike Venuto's number, who is your colleague. What do you need to get an ETF launched? Like, how much money, and can anybody do it? How does that work?
So it really depends on the complexity of the strategy. On our platform, all the different underpinning services are sort of a la carte menu. So depending on the existing resources of an issuer and what it's needed, if this is an active, passive, does it need an index? How complex is the strategy? What sort of rules are in scope for monitoring? Is there an existing RIA in place? Who is the sponsor? So all this sort of informs our sort of ETF strategy that we then work with our partners on. How much does it cost? Like I said, it really depends. It depends on the existing resources of the issuers. It can be, anything from $250,000 per an ETF up. It really depends.
That's really interesting. That was going to be my question as to how much I would need in hand when it comes to the actual cost of launching the fund. And, you mentioned some figures there. How has that changed over time? If we had been having this conversation 5-10 years ago, have we seen those costs compress?
I would say some yes and some not. As the ETF vehicle invites more complex products, for example, the usage of derivatives, I would say on these type of products, the costs still remain relatively high. But, your typical, long-only equity portfolio with a sub-advisor or sponsor that already has all the sort of resources in place in order to bring a product to the marketplace and manage it on an ongoing basis, I would say the cost could have been compressing.
All right, Aga, really interesting conversation. Appreciate you taking the time for us over at ETF IQ. That is Aga Kuplinska of Tidal Financial Group. Now, we're going to take a look at the juicy stories in the ETF industry where we flow and tell. Get it? Today, we are focused on Vangard and its CEO, Salim Ramji. Bloomberg reporting that in the past few months, Ramji has made at least 10 senior hires from companies including BlackRock, which is his former employer, as well as Goldman and Fidelity. Bloomberg's Loukia Gyftopoulou joins us now. She, of course, reported on this story. So, Loukia, I said in the newsletter somewhat cheekily that it's busy down in Valley Forge. So walk us through what the idea is here. What is he bringing on these people exactly to do?
So I think it's been clear from the start that he will look at his external network for talent, and that has been weirdly very well received at Vangard, that traditionally just promoted people from its own ranks. I think the hires now are across the board. So there are people in wealth, there are people in advice, there are ETFs, general counsel is new. So like there's a lot happening. There's a lot of people that he's bringing in, and they're all in key positions at the company.
And Eric, you wrote the book on Vangard. This is a real change from what Vangard has always been like, because it was, I don't want to say it was internal and inward looking, but it has its own ethos.
Absolutely. That's why I called the book The Bogle Effect and not The Vangard Effect, because ultimately Vangard is going to be run by people who went to business school and want to get profits. Bogle was the anomaly in physics. This guy was different. And when he was there and he passed the keys over to the CEOs, he hated that it grew so much. He was like, we're too big, $4 trillion, are you kidding me? Now they're like 10. Anyway, I think it might just be impossible to keep the Bogle DNA that intact when you're growing at this speed.
I think, though, also we're talking about a company that has like over 20,000 employees. I don't know that 30, 40, 50 hires would make that big a difference, but I think the fact they're in key positions does show something about the direction, which is, we're over 10 trillion now. Maybe we need some specific expertise to run the areas where we want to grow.
Has Salim Ramji really put his stamp on the company?
In a way, I think he has. Although it's a big company and Bogle stamp will be everlasting there, he's embraced this a lot. He's been very well received by the staff, which I think everyone was pretty morbid about before he joined, being an outsider. So I think he's slowly putting his stamp there.
All right, good stuff. really appreciate your joining us with this. And of course, it's a story that we would focus really here on ETF IQ. It's kind of tailor-made for us. Bloomberg's Loukia Gyftopoulou joining us on Vangard CEO Marangi, poaching from Goldman, from BlackRock for some key roles. Coming up on ETF IQ, it's time for our IQ test, where Joel Weber puts our ETF knowledge to the test. Here's a sneak peek at one of the questions.
All right, I'm trying to read that, but I have to read another tease here. A reminder, you can listen to Eric and Joel on Trillions. It's their podcast that covers the industry. Eric, we're going to get to it next. Don't go anywhere. This is Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld along with Scarlett Fu and Eric Balchunas. And it's time for IQ Test, where Bloomberg's Joel Weber is going to see whether Scarlett, Eric, and I really know our stuff when it comes to ETFs. Joel co-hosts the Trillions podcast with Eric. He's also the head of games at Bloomberg. And Joel, let's do it.
Let's continue the fun, shall we? All right, last week was pretty strong. We'll see how this week goes, though. Which of the following NASDAQ-linked ETFs has seen the largest outflows year to date? Before you answer this, I'm curious, Eric, how confident are you that you know the answer to this?
This one's pretty good. This one's tough. I'm going to say I'm 70% confident.
70%, okay. Scarlett?
I have no idea, so I'm going to just say, let's go with one.
Okay.
A, sorry.
We're going to go with A. Katie?
I'm going to go with D just because I know it's the biggest ETF.
Okay.
Believe it or not, I'm going to go with C.
Wow.
Okay. All right. Guess what? We only have one winner.
Oh my God!
Katie Greifeld comes up with it.
Let's end it here.
I think that ends a streak for someone, but keeps someone else's streak alive.
Wow, this is amazing. This is really huge.
I told you I messed with the trivia guides by getting cocky.
Eric
You were
was so
very
confident.
cocky just a couple seconds ago, and now look at him. Now we got in his head, because I don't know if it's going to get any easier here. All right, yes, it is Invesco QQQ Trust, which had the largest outflows of those 4 NASDAQ-linked ETFs. Number 2, active ETFs, according to Bloomberg Intelligence, now make up about what percentage of U.S. ETF assets?
Well, we can't have Eric answer it first.
No, I'm not sure he knows this.
Yeah, I might not be the guy.
Really?
All right.
I for sure know this.
I know this.
We're bringing some heaters now.
I'm going to say C.
Okay, C, 33%. Katie?
I'm going to say B, 12%.
Eric?
B is correct. C is the flows.
Okay. He's right.
There you go.
I'm the captain now. Okay, I'll tell you what's right and wrong. B is correct. About 12%. Do you know it globally?
Ooh, it's probably going to be
Slightly smaller.
I would say less than that.
yeah, 9.
Yep, 10%.
Wow.
Okay, final question. I love this one. I take a lot of pride in this.
Ooh.
Tidal Capital's new UFO disclosure ETF.
Wow.
UFOD. It's pretty far out. We can talk more about that in a second. But what's its largest holding? Is it A, Northrop Grumman, B, Amentum Holdings, C, General Electric, or D, Lockheed Martin? Scarlett?
Oh, boy.
Damn, that's tough.
I'm going to go with D.
D,
Lockheed Martin.
Katie?
This is a total shot in the dark. I'm going to say A.
A, Northrop Grumman.
B.
B, Eric's right.
Yes.
Amentum Holdings.
Yeah,
What's the
Amentum
ticker of
Holdings.
Amentum?
No idea.
I had no clue about this one, but there
Did you
was.
just record a podcast on this?
No, but I looked it
The
up
reason I
when
know this is
when it
'cause I did
launched
look
on
at the
Friday.
holdings.
Yeah, I was like, what's in this thing?
Apparently, all these stocks are already incorporating alien technology, but we don't even know if aliens exist. So that's why I looked at the holdings, and because I saw aluminum at first. That's how I remembered A.
There you go.
Yeah.
All right.
Well-
Way to be ahead of it. But
Well-
you know, we've seen a little redemption.
You got to trip him up more.
I'm human.
Really,
I'm
really,
human.
we
That's
took your
what I'm
confidence
saying.
and broke
Yeah.
everything.
Okay.
If you like playing quizzes, there's more. You can go to the Terminal Quiz Go or Bloomberg.com/pointed on the website, where you can play with some leverages and some hedges to really juice your scores.
We can add that to this game as well.
I asked how confident he was, and it really threw him for a loop.
Yeah, he would have 3 times that
We'll see
one.
how it goes next week.
Next week. Joel Weber, so fun as always. Joel is the head of games, which is probably the coolest title that we have at Bloomberg. Quick programming note, though, because of the President's Day holiday, we'll be back on Thursday, February 19th. Don't miss us too much, because that does it for Bloomberg ETF IQ, the TV show. I'm Katie Greifeld, along with Scarlett Fu and Eric Balchunas, and this is Bloomberg.